Hi students, welcome to Sunil's tutorial. I'm Sunil Mirwani and today we'll be doing this chapter called as internal reco. We're going to be doing question number 11 today. We're doing question number 11 today in the books of Safe Moving Limited. In the books of Safe Moving Limited. Right? Let's see this. There's a contingent liability for 60,000. Preference shares are cumulative and dividend are in arrears for 3 years. The capital reduction scheme setting the following terms was duly approved. Preference shares to be reduced to rupees 8 per share and equity shares to rupees 25 paisa each and to be consolidated to 10 rupees and 1 rupees each fully paid. Okay, first let's do this much. Let's write the rule down. LAAL. Increase, decrease, increase, decrease. This is debit, this is credit. Now, preference shares to be reduced to 8 rupees. Liability going down, capital reduction on the credit side. So 6% preference share capital account debit to capital reduction. Amount is going to be reduced to 8 rupees to 8 rupees. That means each preference share is being reduced by 2 rupees. On 60,000, 2 rupees, 1,20,000. Then at 60,000 shares, I'm reducing each share by 2 rupees, being preference shares reduced. Preference shares reduced. Next, they are saying that equity shares to be reduced to 25 paisa. Presently they are of 1 rupee each. That means they are going to be reduced by 75 paisa. Value of liability going down, capital reduction on the credit side. Equity share capital account debit to capital reduction. Right? Now this is 75 paisa on how many shares? On 12 lakh shares. Some of these calculate 9 lakhs. Mean equity shares reduced. Next, let's move on ahead. And they are to be consolidated as shares of rupees 10 each and 1 each fully paid up. Right? So you take the old preference shares and you give them new preference shares. So debit what comes in? Preference shares, share capital, debit, and you are issuing new 6% preference share capital. Right? I'm consolidating them and giving it to you. Now, preference share capital was 6 lakhs, out of which you have written off 1,20,000, so that leaves you with 4,80,000. 4,80,000 being preference shares consolidated. Right? Then same way you have to consolidate equity shares. Debit what comes in? Equity share capital account debit. The old equity shares will come in to equity share capital. Right? Now, your equity share capital as per balance sheet was 12 lakhs, out of which 9 lakhs has been written off, so 3 lakh rupees remain. Equity shares consolidated. Right? Next, let's move on ahead. The preference shareholders waive 2/3 of the dividend in arrears and to receive equity shares for the balance. Okay. Now my preference dividend was in arrears for 3 years. Let's first calculate the dividend, people. Dividend. These are 6% preference share. Preference share capital as per the balance sheet is 6 lakhs. and it is in arrears for 3 years. Someone please calculate this. That means for the last 3 years I haven't paid you the money.
1,08,000.
So my total dividend is 1,08,000. They have agreed to waive 2/3. That means I have to pay 1/3. If they are not, I don't have to pay them 2/3. That means the balance 1/3 I have to pay them. Someone tell me how much is that? 36,000.
Yep.
Right? And how I got to pay them and receive equity share for the balance. I have to pay them in terms of equity shares. Debit what comes in, credit what goes out. Equity shares are going out. Now the word preference dividend is not there in the balance sheet. Since it is not there in the balance sheet, I cannot use it in the journal. So in this case, this will be capital reduction account debit. Capital reduction account debit to equity share capital. Amount is going to be 36,000. The preference dividend paid. Fine. Next, authorized share capital is to be restored to 6 lakh preference shares of 10 each and 12 lakh equity shares of 1 each. Now, the change in authorized share capital is never shown in the journal, it will be shown only in the balance sheet. Let's move on ahead. Shares in subsidiary company were sold to an outsider for 3 lakhs. Sold. Money is coming in. Bank account debit. Leave a line to investment in subsidiary limited. Right? Now investment in subsidiary limited as per the balance sheet was 1,50,000. They are saying that you sold it for 3 lakhs. The difference is going to be to capital reduction. 1,50,000 being investment sold. Next, let's move on ahead. All intangible and fictitious assets are to be eliminated and bad debts of 42,000, obsolete stock of 60,000 to be written off. Assets going down, capital reduction on the debit side. Capital reduction account debit to goodwill. Goodwill is 2,40,000. To goodwill is done. Then intangible assets, profit and loss and advertising expenses. Profit and loss is given to you as 5,28,000. To advertisement expense. Advertisement expense is 1,20,000. Right? And they are saying besides that, bad debts, so that means debtors 42,000. To debtors 42,000. To stock, obsolete stock of 60,000. Right? Chalo, let's see this. Someone please add all that and tell me how much is it?
9,90,000.
9,90,000 being assets written off. Next, let's move on ahead. Debenture holders to take over one of the company's property, book value 1,08,000 for 1,20,000. Now, property. The only property that is there in the balance sheet is land and building. Now they are taking over 1,08,000 worth property for 1,20,000. That means the value of asset is going up. Asset going up means capital reduction on the credit side. So this will be land and building account debit. To capital reduction. you are increasing the value from 1,08,000 to 1,20,000. That means you are increasing the value by 12,000, being asset revalued. Right? Now, they are saying that the debenture holder took over one of the company's property in part satisfaction of the debentures and further provided cash of 90,000 on floating charges, the arrears of interest to be paid. Very good entry. Debit the receiver, 6% debenture account. They are taking over the company's property. Debit what comes in, credit what goes out to land and building. Right? They are taking over land and building for 1,20,000. Besides, they are saying that they are going to provide a further cash of 90,000. Now, if they are providing you a cash of 90,000, that means cash is coming in for you. Debit what comes in? Bank account debit. Cash is coming in 90,000. Right? Besides that, they are saying that part satisfaction. Arrears of interest are paid. Okay. We'll pay that later. Now let's see this. So in that case, the difference is going to be 30,000. Right? Being debentures claim settled. Being let me see the entry, guys. They are saying that 1,20,000 is the debenture holders they are taking over land and building for, and
Arrears of interest paid.
that I'll do. I haven't done that. And to provide further cash of 90,000 on the floating charge. They are providing you cash. Cash is coming in on a floating charge. Right? Okay. Let's see this. That is done. Now they are saying that the arrears of interest are paid. Arrears of interest are paid. Paid. Money is going out. So this is going to be interest. Debenture interest account debit. Debenture interest account debit to bank. How much is it? They are saying that it is 12,000. The debenture interest paid. Right? Next, let's move on ahead. Directors refund 20,000 of fees previously received by them. Refund, money is coming in. Bank account debit. Now let's see, do I have directors' fees in the balance sheet? No. So to capital reduction. $20,000. Being refund received. Next, the contingent liability materialized in the sum stated by the company, and 30,000 of these damages in action against one of the direct 30,000 of these damages in action against one of its directors, which was debited to his loan account of 48,000, and the balance of loan was paid in cash on his resignation. Right? So director's loan has been paid off. Director's loan, debit the receiver. Director's loan, account debit, paid. Money is going out to bank. Right? Now director's loan is, as per the balance sheet, no, they are saying that the loan amount is 48,000 as per the adjustment. Out of which, how much is recovered from the director for his liability? 30,000. So he has been paid only 12,000 to capital reduction. 30,000. Being 18,000. Yeah. Being director's loan paid. Right. Next, the remaining directors agreed to take equity shares in satisfaction of their claim. Now, total directors loan as per the balance sheet is 1,50,000, out of which 48,000 has been paid. So, remaining is 1,02,000, right? Directors loan account debit. To equity share capital, right? Directors loan, they are going to be paid in terms of equity share capital. That's 1,02,000. Being directors loan paid. Right? Let's make a capital reduction account. Leave space for one journal entry and make capital reduction. Capital reduction on the credit side by 6% preference shares, 1,20,000. Credit side by equity shares, amount is 9 lakhs. Then you have capital reduction on the credit side by bank, 1,50,000. Then you have capital reduction on the debit side to goodwill. To goodwill is 2,40,000. To profit and loss, 5,28,000. Then to advertisement expense is 1,20,000. To debtors, 42,000. To stock, 60,000. Then you have capital reduction on the credit side by land and building. Land and building is 12,000. Then no capital reduction here. Capital reduction on the credit side by bank. Capital reduction on the credit side by director's loan. Right? Some of these tallies.
12,32,000.
12 lakh 32,000.
2,06,000.
2,06,000 difference. 12 lakh 32,000.
So don't we have equity share capital on the debit side, capital reduction to equity share capital system?
Now 36,000.
36,000.
You are on the debit side, so this is two equity shares. 36,000.
2,06,000.
After putting the 36,000,
Yeah.
2,06,000 is the difference. This is to capital reserve. Right. Next. Let's make a balance sheet, guys. Balance sheet as on. Yeah. Liabilities. Rupees. Assets. Rupees. Fast journal entry for this. This is on the debit side, so this will go on the credit side. So this will be capital reduction account debit. to capital reserve. Amount is 2,06,000. Being reserve used. Let's start. They are saying that the authorized share capital, the first journal entry, the authorized share capital is to be restored to 60,000 preference shares. So let's see this. Authorized share capital. Authorized share capital is to be restored to 60,000 preference shares of rupees 10 each. Preference shares of rupees 10 each, 6 lakhs, right? And it is to be restored to 12 lakh equity shares of rupees 1 each. 12 lakh equity shares of rupees 1 each. That is 12 lakhs. 18 lakhs. Right? Okay. Now once this is done, let's move on ahead. You have preference share capital. 6% in issued and subscribed capital. Issued and subscribed. Under issued and subscribed, you have equity shares. No, first is 6% preference shares. Not that it will make a difference. We'll go and ask for the order only. 6% preference shares is 6 lakhs, out of which 1,20,000 is written off. That's it. So that is 4,80,000. Then you have equity shares. Equity shares as per the balance sheet is 12 lakhs. Then minus 9 lakhs. Then add 36,000. And then add 1,02,000. 4 lakh. 4 lakh. 36,000.
1 lakh 2,000.
4 lakh 38,000. Okay. Reserves and surplus. Let's see reserves and surplus. There's nothing given in the balance sheet, so you will have only your capital reserve. Capital reserve is 2,06,000. Then you have secured loans. Under secured loans, you have 6% debentures. 6% debentures 2,40,000, and you have on the debit side 30,000. So that will give you 2,10,000. Then you have unsecured loans. Unsecured loan is bank overdraft and director's loan. No, director's loan, just director's loan. Director's loan is unsecured loan, 150, and this is going to be 150. The total amount is written off. Then you have current liabilities.
So bank OD director's loan is nil.
Bank OD is going to be a current liability. So bank OD is 3,30,000. Then you have creditors. Creditors is 5,40,000. Have you used creditors anywhere in the sum? No. No. So 5,40,000 as it is. Next, fixed assets. Fixed assets. Let's see this. You have goodwill. Goodwill is 240 and it has been written off. So nil. Then you have land and building. Land and building is 5,34,000. And do we have land and building? Yes. It has been appreciated by 12,000. So 534 plus 12,000 minus 1,20,000. Someone please do that. 34, 44, 48, 28. So that means 428. Someone cross check please.
426.
426.
426. Okay. Plant is 5,10,000. And do we have plant here, guys? Plant. No. We don't have plant. So plant as it is 5,10,000. Right? Then that's it. Then you have investments. Investments in subsidiary company were 1,50,000 on the credit side, sold, so nil. Then you have current assets. Under current assets you have stock. Stock was 4,50,000. Do we have stock? Yes.
Yeah.
60,000. It has been written off by 60,000. So 390. Then you have debtors. Debtors was 5,40,000. It has been written off by 42,000. So that is 4,98,000. Then you have profit and loss, fully written off. Then you have advertisement expense, fully written off. And then you have bank. Now, bank add 3 lakhs plus 90,000 plus 20,000 minus 18,000. That's it.
3,80,000.
3 lakh
80,000. 80.
Once again, we have bank, which is 3 lakhs plus 90,000 plus 12,000, no, minus 12,000 plus 20,000 and minus 18,000. How much is it?
3,80,000.
3,80,000. Right? How much is the balance sheet, guys?
22,04,000.
22,04,000. 22,04,000. Right? This finishes the sum. We'll stop this here for the day. Thank you very much.